Welcome to the Alain Guillot podcast, a podcast about life, leadership, and money matters. Our guest today is Ann Lester. Ann is a former head of retirement solutions for JP Morgan Asset Management. Through her 29 years at JP Morgan, Ann has become a regular commentator on an array of retirement issues on outlets such as CNBC, Bloomberg TV, the Wall Street Journal, pensions and investments, and many others. She's in a mission to help Americans understand that it is possible to achieve a happy and timely retirement. And thank you so much for joining us today.
Well, thank you so much for giving me this chance to chat with people.
So, personal finance and retirement is one of the issues that I am more excited about. I came to Canada as an immigrant, and the first thing that I had, even as I quote unquote get out of the airplane, was how am I going to retire? And this is an issue that, of course, I have been talking about for many years. But I wonder you, how is it that you became interested in finance? And then why in retirement as per se? Why that? I mean, the financial sector is so huge.
So, like all good things, I think it was kind of an accident. But I first started getting interested in finance when I was a kid, and I read a book that my dad picked up in an airport called The Silver Bears, which was about cornering the silver market in the
Mhm.
70s. It was one of those thrillers with the shiny cover. And I just thought it sounded incredibly glamorous, right? High finance. So when I was in college, I actually thought I wanted to be an investment banker because in the 80s, that's what everybody wanted to be. Um, and I know now that I probably would not have been very happy in that job, but sort of life happened, and I ended up working in politics for a few years, moved to Tokyo, and when I was in Tokyo, I got a chance to work for Chase Manhattan Bank on their trading desk as an intern. And so I learned about trading stocks and bonds and really thought that was fun. I just really enjoyed it. So then when I moved to Italy, which is, again, one of these crazy life stories, I was interviewing for jobs and ended up getting hired by JP Morgan as a bond trader for their asset management division. But I didn't really even know what asset management was. It was, again, kind of an accident that I ended up in that job. But, I quickly learned that managing other people's money has a huge fiduciary component to it. And that is very value aligned with me, right? Because you always have to be acting in your client's best interest and never for the interest of yourself. And I think a lot of parts of the finance business assume that everybody knows the rules and everybody's taking care of themselves. But when you're acting in this fiduciary capacity, you really have to only act in your client's interests. And I really found that very resonant. And then when we moved back to New York in the 90s, I joined the team that I ultimately stayed on for 20 years, which was the team that managed balanced funds. And I was asked to take over the retirement 401k side of that business back in 2003. And so I ended up building JP Morgan's target date funds, and the rest is kind of history. It just took off from there. But it really kind of happened by accident, I think. I didn't know it existed when I started working in finance.
In the field of finance, who has a fiduciary duty towards the client and who doesn't? Because
Ooh.
this is one of the issues that many people think this sales representative have the best interest, my best interest at heart, and many times it's not, and sometimes there is not a clear line of who is acting on my best interest and who is acting on their best interest and trying to get a nice commission.
It's such a great question. I think it's one of the most important things for sort of consumers to understand. If your money is in a 401k plan or a pension plan, it is governed by a law called ERISA, and that stands for Employee Retirement Investment something something Savings Act, maybe. And that basically has been in place since the 70s. And that says if you're acting on behalf of an employee or a retiree, you are legally obligated to only act in their interest and to avoid or disclose any potential conflicts of interest. So if your money is in a pension plan that's your company's money, it is absolutely governed by this principle. When you're working with a financial advisor or a bank, and they're managing your money for you or with you, it gets a little more complicated. If you've hired something called a registered investment advisor, RIA, they generally charge you a fee that's a percentage of your account. And depending on how much money they're managing, that fee could be larger or smaller. But it's typically 1%, or if you've got a lot of money, maybe 0.5% of what you are asking them to manage. And you pay no other fees or commissions to that person. You may be paying other fees to the mutual funds or the ETFs that that individual is putting your money into, but that individual, because they get one flat fee as a percentage of their assets, has no incentive to put your money in this thing versus that thing. If you, on the other hand, have a brokerage account, the broker is only legally obligated to suggest things to you or do things for you that are suitable, and is under no obligation, I think, to disclose any legal conflicts of interest. For instance, if they work for a specific company, they can offer you to buy a product that their company would benefit from financially, or that they would get a higher commission for. I think the good brokers tell you, but I don't believe they have to tell you. So they are legally obligated to show you things that are suitable, but they don't necessarily only have to act in your interest. They can also look after themselves. So again, for some people, especially clients who have lower balances, brokerage accounts can be very effective because the fees are typically lower, but you have to keep an eye on the conflicts.
Right. Okay. This is very important. And this is an issue that I have brought up many times because me, myself, I used to be a financial advisor
Right.
and I used to earn my living through commission. And the sales meetings that I had in the office is how we can sell the most product with the highest service fee and make it appear as we are looking out for our clients. And needless to say, I didn't last long uh, in that job, mostly because I saw a huge conflict of interest that sometimes the products that give me the biggest commission are not the best products for my client. And anyway, I retired. I kept my blog, financial blog, but I retired from that field because I couldn't reconcile that conflict of interest.
And
Uh,
I should, excuse me, note that I was speaking specifically about US law. I think most countries have similar kinds of laws that regulate conflicts, but I want to be clear, I was speaking specifically about the US system.
yes, yes, perfect. Okay, well, then I see that you are focusing on helping people in their 20s and 30s. Why this group of people in particular?
So, a couple of reasons. One, I have children that age, so I'm feeling really, focused on them a little bit. But really, I think people feeling unsure or unsafe or confused or afraid, a lot of negative emotions, I think, come up for many people about their money. And I think that's true at any age. What I really decided to do was focus on a group of people who typically don't have a lot of money and therefore are perhaps a little less focused on by the financial services industry. I think boomers and Gen Xers now have really interesting balances. Many people, even people that are sort of typical working people, have 401k balances that are 50, 100, 150, $200,000 and so or more. So the financial services community has lots of products and people who can help them and give them advice. And I think when I look at the books out there and the sort of how to handle things, a lot of them are focused on the boomers because that's the biggest group of people who are kind of out there. But what I really find myself called to do is help people avoid the same mistakes I made in my 20s and 30s. And, I was really lucky that I ended up in a part of the industry and developing a product set that worked really well. So that kind of helped me solve my savings deficit, um, because I was paid quite well for the product that I developed and ran. But had I known and understood in my 20s and 30s the decisions that I were making, or I should stop and say I didn't know I was making decisions, but I was, and those decisions have had a huge impact on our long-term financial stability, and we would have been much better off had I made a few small changes earlier. And so for people in their 20s and 30s, time is such a huge part of their um, portfolio, right? Time is actually an asset for them. When you're in your 50s and 60s, time is not an asset anymore. It's like a negative thing
Mm.
because you don't have it anymore. And if things go wrong, it's much harder to recover. But when you're young, because of compound returns on interest, time is like this huge force multiplier of your returns. And if you start saving even a little bit in your 20s and 30s, you will have to save a lot less when you're older. So it
Right.
helps you enjoy your life more as you get older, either as you're working and having to save less, or when you retire and have a much bigger nest egg that will give you a lot more choice and freedom, or it'll let you retire earlier. So I don't think people really understand that very well because it's complicated.
Mm. Well, I think you created a cliffhanger there that I don't want to skip. So please tell us more. Can you tell us one of the most embarrassing financial decisions you
Ooh.
made? Just one.
Oh, there's so many to choose
I see
from.
your face already turning red.
Yeah, what do you mean? Embarrassing? So I really was living paycheck to paycheck when I first started out, and I really had not figured out how to match my expenses to my monthly income, which was very low because I was working in politics and they do not pay people who are 21 years old very well in politics. So I was really, half of my income was going on my rent, and, I had a car and
You have
gas
to
and
look nice.
utilities. I had to look nice enough. And so I really struggled, and my credit card debt kept creeping up, and I didn't really understand, about minimum payments. And I was like, as long as I can make the minimum payments, it'll be fine. So after about a year, I got a bonus, and the bonus was $800, which was enough to pay down half of my credit card debt. And now this was in the 80s. That was a lot of money. And it's still a lot of money, but it was a lot of money back then. And I had this check, and it was in my checking account, and so I bought a baby grand piano.
Hmm. I know one person who did that during COVID time. What am I gonna do with this check from the government? I'm gonna buy me a baby piano. I do know that one.
Okay,
Someone
so
who
I'm not
did.
the only one who did that. So I was a really serious pianist as a kid, and it was a big part of my identity, and I couldn't imagine not having a piano. Now, the reality is I'd kind of stopped practicing seriously when I got to college, and once I stopped taking lessons, I took lessons all the way through college, but once I stopped taking lessons, I really stopped playing. So I had this piano that I, played sometimes. It made me feel good when I walked by it, but it was not a very smart thing to do with my money.
Okay, well, thank you so much for sharing that. I feel that people in the age range that you are trying to help, they have such a challenging uh, set of circumstances. They have high housing costs, especially if they live in one of these popular cities. They have huge student debt problems. I mean, education in the US is enormous. And then they have a huge marketing machine asking them to buy the latest gadget. I mean, people cannot live without the latest phone that is coming out this year. Now people have lost a fascination with the latest car, but the gadgets, my God, they are making a big hole in people's wallet.
I agree completely, and I think one of the things that I talk about is, on the one hand, the reality that you've got. I think you said student loans too, but I mean student loans for a lot of people and rent are huge. Like right there, you've taken away, way more than half maybe of a lot of people's disposable income, and you're sort of stuck paying that. You can't negotiate those very well. Um, Something else that happens, and I think this is a big part of what I want to talk about, is the fact that we're not wired to make rational financial decisions. And it's really hard to deny yourself pleasure, especially when your brain is wired to grab what you need right now and run. And evolutionarily, it's because the saber-toothed tiger was going to eat you, so grab it and go. um, and what you talked about, the marketing machine, right? That marketing machine knows all of that brain science and is playing it, right? And playing you a little bit to make sure that you respond to what they're doing. So your brain is wired to help that, not wired to help you go, no, I won't have that decision. I'll do the thing that feels bad right now, which is sacrifice. So that's a real thing. And if you're wrestling with, as I did, with feelings of inadequacy or it's my fault, if I were a better person, I could make better choices. And oh, by the way, as I look at the pile of cookies I just made, it's true with food too. I struggle with that one, still do. Um, you know, Giving yourself permission to acknowledge that it's not necessarily your fault or that you're a bad person if you're struggling with this was, I think, a very important thing for me in understanding that maybe it wasn't my fault. I just had to understand that my brain was going to make me do things. And how do I set a system up to make sure my brain doesn't have to think about the choice? One really important thing. So automating savings to me is one of the best things you can do, whether it's in your workplace savings program like a 401k or defined contribution plan, or whether it's just into a savings account. Have it automated so you don't have to make the decision. The second thing that I think people lose track of is something called the Hedonic Treadmill, which means lifestyle creep. And you talked about getting the latest gadget or buying the new car. And when you see your friends doing something, you're like, I want that. That looks so fun and so cool. And I still remember I had a really terrible used clunker of a car that I had to put a can of oil in every time I filled the gas tank up. I mean, this was, again, a long time ago. But it had windows that didn't work. And I finally had enough money to replace the car and get a car that had windows that worked. And like for the first 2 weeks, I'm like, oh man, I can roll down the windows. This is great. I have windows that work. And it made me really happy for like a week. And then I was like, yeah, whatever. My car has windows that work. And it stopped making me happy. And I think for a lot of purchases, you do fall into this trap of thinking that it'll keep making me happy, but it wears off. But I had a higher car payment, and I had the higher car payment forever, right? So you've when your income goes up, you think, great, I can spend more money, I can move into a bigger apartment, I can buy a nicer car, I can subscribe to 5 more, streaming services, whatever your choices are. Those things make you really happy for a little while, and then it wears off. So I think the second thing that's incredibly important that people need to do is try to build in a way of increasing how much you save when you get a raise.
Right.
It's really hard to do it like right now because then you're taking stuff away from yourself and that feels terrible. Like you feel like you're penalizing yourself or punishing yourself. But if you say, next time I get a raise, I'm going to bump up my savings, not all of it. Don't save all of it because then, I mean, maybe if you have a lot of debts you need to pay down, you should do that too. But like if you give yourself some of the raise to enjoy, but do like responsible things with the other part of your raise, I think that's a great way to make your brain happy, you feel happy, and your future self will be a lot happier.
There is a program that I heard about called Save More Tomorrow.
Yes.
Well, I'm gonna let you explain it since you are
So Richard
not.
Thaler won the Nobel Prize for it.
Yes.
It's a fabulous thing, and it's this notion, and some employers will let you do this in your 401k system, and some employers do it automatically for you. Well, they'll push up your savings rate by like 1% a year and try to time it to when they give raises. But that notion of save more tomorrow, when people are put into a program like that, like 80 or 90% of the people stick with the program. But if you ask people, increase your savings rate, only about 20% do it. And I think a lot of it is the reality of the situation, but some of it is that it feels bad. And another behavioral thing that I think is fascinating is that When scientists ran some studies and asked people to think about themselves, they were, doing brain imaging, and they asked people to think about themselves, and a certain part of their brain lit up. And then they showed them a photo of a celebrity and said, okay, think about the celebrity, and a totally different part of their brain lit up. And then they said, okay, think about yourself in retirement in 20 years' time. And the part of the brain that lit up was the stranger part. So when you're saving for retirement, you're saving for this other random person that's a stranger, and it's harder to give your money to somebody you don't know, right? I mean, if it's your family or yeah, of course you can help them. But when it's this other stranger, it's really hard. And so this notion of save more tomorrow, you're not sacrificing for today. So it's just emotionally easier to do. And one of the things I've really realized in the 20 years I've been working in the retirement space is, just because something is financially rational or the optimal answer doesn't mean it's the right answer for people emotionally. And you've got to do both sides of the equation, right? You can't just make it financially efficient. It's got to work emotionally too. And so I think the Save More Tomorrow is a fabulous example of making both of those things work together.
Well, assuming one of my listeners who is in their 20s or 30s, they decide that they want to start making retirement a priority, and this sea of information, how would they go around finding the proper information? Because it's just as easy as finding the improper information and put everything in Bitcoin. Not that I'm saying
Yeah.
Bitcoin is a bad investment,
Well,
but
we
you
don't
know
know
what I
if it's
mean.
a good. I mean, so I think for cryptocurrency, it's done really well lately, and that can feel really exciting. And it may eventually, or in the fullness of time, turn out to have been a great idea. I don't know, but I don't think we have the. I personally don't have the level of comfort that we know how it works.
Right.
Right? We know why stocks tend to go up over the long term because companies create value, the economy grows. There's actually a lot of evidence and also a lot of theory behind why those things happen at kind of a similar over long periods of time. Like 7 to 10% is kind of what the stock market does. And yeah, there are years when it does something really different. In fact, it almost always does something really different on a 1 year basis, but over the long time, it generally goes up. Bonds, similar, right? So, in terms of finding information, I think the first place to go is if you're working and have an employer that offers a workplace savings program, that's your first stop
Mm.
for retirement. And make sure you're saving as much as you can into that program. And again, if you're in the United States and you're listening and you have a 401k plan, your company will match part of what you save, and that match is free money.
Mm.
You want the free money. You really want that money.
Free
So
money is
make
good.
sure you're contributing at least enough to get the match. If you can afford to contribute more, I think that's the first place to increase savings until you get to the maximum amount that you're allowed, or 10 to 15% of your salary before taxes or your gross salary. And if you're doing that, I think you're saving enough for your retirement, especially if you're in your 20s or 30s. You're going to be fine. Just keep doing that. If you don't have a workplace savings program, it's a little harder. And the reason I encourage that workplace savings is because your employer is a fiduciary.
Mm.
So they have to make decisions that are good for you. And typically the fees are lower than anything you could do by yourself. Typically, not always. So if that's not an option for you, what I would do then is look into setting up your own individual retirement account or IRA. And the reason this is important is because when you save in an account like an IRA, you don't pay taxes on it.
Mm.
Now, you don't pay taxes on it when you contribute the money in a regular IRA. You pay the taxes on it when you take the money out after you're, in your 60s. There's something called a Roth IRA, and that's a little different. You pay taxes just like you do now, and then you put your money in, but then you never pay taxes on it again. And for a lot of younger workers, that Roth IRA makes a lot of sense because if you're earning $30,000 or $40,000 a year, you might not be paying any or many federal taxes. So the tax break that you get by not having to pay taxes on it when you're 60 is going to be worth a lot. So, you know, Roth IRA, regular IRA, might be slightly better to do a Roth IRA, but frankly, any IRA is a good idea. So IRA first, and then think maybe about Roth. That's like grad school. Once you have your money going into one of these tax advantaged retirement vehicles, you know, I think, now again, I'm biased because I did this for a long time, right? I think the ideal way to invest that money is in a target date fund, because a target date fund, and the way it works is that the name of the fund is the year you expect to retire. So if you're 25 years old, I can do this math, you'll be retiring in 40 years, so that would be in 1960 something, right? You get the 1960 or 1965 fund. The manager of that fund will today have a lot of equities in that portfolio, maybe almost 100% in equities. But as time goes by, they will de-risk that fund or shift automatically some of that money into bonds for you. So you don't have to think about it. You just set it and forget it, and your job is just to save. And that's your job. And the markets will go up and they'll go down, and the manager behind the scenes is making some decisions for you. Now, I would tell you that, all target date funds are a little bit different, and you could go, spend a lot of time researching an index fund versus an active fund and this provider versus that provider. What you want to do is find a provider who will not charge you a lot of commissions when you buy the fund, so you can buy direct, and because it's in a regular contribution, they'll put you in a share class, and I don't know if we want to go there or not, but they'll keep an eye on commissions. I would say for most individuals doing this by themselves who don't have a lot of experience, like reading fund language and like it's kind of scary doing it, the probably easiest thing to do is to put it into an index fund. And companies like Vanguard or BlackRock offer target date funds. And, I'm not going to make any recommendations. I'm not going to say you should buy this or that, but pretty much any target date fund has a pretty good chance of doing better than the individual does trying to pick stuff, because when you try to start picking things, you get really caught in this. Is this the right thing? How about that one? I don't know. I'll worry about it later. And then you don't make a decision. That's bad. Second bad thing that happens is you start day trading. And you do not want to day trade your retirement account.
I did that for many years.
I mean, you might be brilliant and it might work out really, really well, but generally it doesn't, because you buy when it feels good. That's when the market's going up. And then the market starts going down and you go, oh man, what did I do? This is terrible. I'm going to sell. So you buy and you sell and you buy and you sell and you lose money. So that's a terrible thing to do. So if you want to carve out a little bit of your money because you've been reading about this stuff online and you want to go buy GameStop or whatever, AMC or crypto, that's I'm not going to tell you not to do it. It can be a fabulous learning experience, but do it with your entertainment budget.
Right.
And do it with other money other than your retirement savings. That's got to kind of be boring and steady. Just let that be boring and steady, because time, if you're in your 20s, is your rocket fuel, not your brilliant buying and selling, right? That's different. And if you want to try it, go for it. Just do it with your entertainment budget. It's like going to Vegas.
Well, as I hear you speaking, I am amazed at how clear you explain all this complex finance information. I wonder what else do you have to offer? I saw your website; it looks very nice. But what is it that you do as a business now?
Well, so really my business is going to be, I'm on a corporate board and I'm going to be joining another one. And I guess I'm viewing that as my business. I mean, I'm earning a little money for that. And what I really want to do is just talk to people and help them understand these things. So I'm on social media. I'm on Instagram and Twitter and LinkedIn. You can find all those links on my website. And I'm writing a book. And I want to be out giving speeches about this. So I guess I don't view this as a business. I view this, I want to break even on this stuff, which I will just note that setting all this stuff up is making me not break even right now. But, eventually I'll have a book deal and I'll be giving speeches. And, I hope to break even. But I'm not trying to make money doing this. I just want to share this information with people. And again, thank you for mentioning that you find it easy to follow, because I think the other thing that really intimidates people behind the behavioral economics side is that we use too much jargon in this industry. And I think a lot of people in financial services are in financial services because they think the numbers are kind of fun and cool, and like it's like this cool intellectual game, or they just want to make money and that's really motivating. But if you're just the average consumer, you don't, it's kind of like it's a turnoff, right? It's too much information. The stakes are really high. You could screw it up. Like it provokes anxiety. And I think if you're confronting a situation that you know is difficult, that you feel stupid around, and you're pretty sure you're not doing it right, that's a great recipe for A, making some bad decisions, and B, feeling terrible about it, even if you're doing the right things. So I think we need to do, and I say we in the financial services industry because I mean, I'm not working for anybody right now, but I think the financial services industry and we as people who are trying to help people navigate it really have an obligation to try to take some of the heat out, turn down the heat, even by using simpler language. I think that makes a huge difference.
Well, and I cannot thank you enough for your time. I wonder if you could tell us where can the listeners follow the work that you do.
So AnnLester.com, ANNELESTER.com. You can put your email address in there. At some point, I'll start a newsletter, which I confess I haven't done yet. But you can also find all the social media links. And I'm pretty active on social media with posts and tips and ideas and flagging articles that I think are worth reading by other people. So there's a way to get into the flow of information there. And then as soon as I know when my book's coming out and how to get that, I'll be sure to let people know as well.
I hope to speak to you again at that time. Well, thank you so much, and all those links will be in the show notes. Goodbye.
Okay, thank you so much. Wonderful to chat with you.